Hello, everyone. Thank you so much for joining us today for our third session of the Essentials of Wealth Management. Today's presentation will be on asset protection, and we have Melissa Miller from Fulcrum Wealth Advisors talking to us today. Just a few housekeeping things before I turn it over to Melissa here. So you'll see here that we are in webinar mode, which means that while you're not able to share your video or your mic, if you have a question, you're able to raise your hand and we are able to give you permission to talk. And so you'll be able to ask your question live. But we will have a Q&A session kind of built in throughout the presentation, one in the middle, one in the end. So if you have any questions, feel free to park them in either the Q&A box or the chat box function, and we will get to those questions then. But without further ado, I will go ahead and turn it over to Melissa here.
Well, thank you so much, Kiana, and everyone attending the third session. As Kiana said, this is on asset protection. We started with the first webinar in the wealth management series as behavioral finance. I kind of did that on purpose because I wanted to have a good, or let you guys have a good idea of the way we think about finances when we make investment decisions. And then we moved along to the second webinar, which was on financial planning. So we looked at the whole comprehensive financial planning picture, building the house. And so now, third webinar, we're going to take a piece of that financial plan out, which is extremely important and applies to a lot of people in different ways. So again, thank you, Kiana. Thank you to the Parkinson's Association of the Carolinas. And let's get started talking about asset protection. So the outline, this may look familiar if you've joined my other webinars, but we're just going to have three different areas. The introduction, we're really going to open up with what is risk management, what is asset protection, because they go hand in hand. In the financial planning process, some people do call it risk management, others call it asset protection. We'll talk about the similarities, and then we will also talk about protecting ourselves as well as our assets. So in the areas of focus, we're going to actually drill down into different types of insurance, and then as well as when it comes to assets, protecting them from our creditors, predators, in-laws, and outlaws. So we will end the presentation with just some ideas on how to get started with asset protection so it's not so overwhelming. Introduction, again, you already know my name is Melissa Miller. I'm a financial advisor with Fulcrum Wealth Advisors, and I have a bachelor's degree in finance from UNC Charlotte. First generation college graduate. I am very proud of that, and I love to give back to UNCC. So I am on the alumni council for the Belk College of Business, and then I also volunteer as an associate for the Women in Business Initiative. And I've got over 10 years of experience in financial planning. I've had various roles all the way from, answering the phones, meeting with clients, doing the paperwork, all the way up till now, being an actual financial advisor with my own book of business. And on a personal level, I always just like to include this because you're probably thinking, well, why did you choose financial planning? And, what do you get out of it that makes it fulfilling? And the answer to that is I really enjoy helping people. So at the end of the day, I just want to have an impact on somebody. It can be just one person, but I'm happy with that. I just want to change people's lives and educate them when it becomes financial planning, because growing up, I grew up in a middle class, low to middle class family. And, we did have our fair share problems, especially when 2000. So I've really learned since then that I want to make an impact on other people's lives. And if I can prevent and educate them, then maybe they won't have to go through what I've gone through. I have my husband, Alex. We're going to be married 9 years, November 1st. And we have a golden doodle moose who is going to be 7. but he acts still like a puppy. Keeps us busy, that's for sure. And last but not least, I love playing guitar, and that's actually what got me into the Parkinson's Association. So let me go ahead and explain it in the next slide. So why PAC? And, that's a really simple answer to me. And it's my uncle. So my uncle lives in New Jersey, and we've always been really close with guitar. So we have that bond. We love playing. In 2006, he was diagnosed with Parkinson's disease. And oddly enough, that's when he was first starting to pick up the guitar again and really play every day. And he told me the first year or two, he had a lot of different issues because of the diagnosis and playing guitar, but he pushed through those. And I mean, he's an amazing guitar player. So the left picture is he and I playing at my grandparents' house. And then the picture on the right is when he and my aunt took us to Nazareth, Pennsylvania, to the Martin Guitar Factory, and we did a tour. So that picture in the bottom right-hand corner, that's probably around 2017, 2018. And so the last time we went to visit was last year. So it was May 2022. And I really noticed just a difference in the fact that when we sat down to play guitar, his mind knew everything. He knew what to do, the theory behind it, but just actually getting his body, his hands, his posture, everything like that to fall into place, he was really struggling. And so I thought to myself, I really don't know a lot about Parkinson's disease, and I really want to learn because I want to be able to help he and my aunt, but not only them, I want to help other people. And so I do know that it affects people differently. So got back to Charlotte and started Googling if there were any groups or anything within Charlotte, and immediately PAC showed up. So, had a phone call, talked with Anne Marie, met with both her and Kiana a few times, and the rest is history. So I started out on the marketing committee, and most recently I joined the finance committee. So I wanted to start this off a little lighthearted because let's face it, when we talk about risk management and asset protection, it's really, it's not exciting stuff. So I thought, hey, let's bring in a game analogy. So I like to think of risk as Jenga. So what I mean by that is when you really think about the message of Jenga, it's that basically anything can happen, especially if you're not expecting it. In other words, the tower tumbling down. And also, if we think about it, Jenga is a game of choice, not chance. So we're actually choosing which blocks we want to, pull out to build the tower. So I like to think of each block as a possible risk that you may come across in the future, and also just ways to prevent those risks. And if we do that, then we're helping ourselves being set up for success. But on the other hand, if we aren't planning, if we're just kind of grabbing different blocks and, not really caring or thinking, oh, that'll never happen to me, and then the tower falls and collapses, then, that's also really, that could happen to you. I hope it doesn't. But, the point of this is just to show you that Jenga, oddly enough, is a lot like asset protection. So risk management, if we look at the actual definition of risk management, it really deals with protecting our family. So that means protecting them in a sense of if we were to pass away, or we got hurt at work and we can no longer work and we were the sole income provider, or if we got ill and had to be taken care of for a long-term basis, how would that affect our family and their standard of living, and what ways can we plan ahead for that? Also, hand in hand, asset protection. This part is going to actually focus more so on protecting your assets, your physical assets, whether it be personal or business. And one important thing to always remember as we, go through this webinar is that financial planning and estate planning go hand in hand. So I really encourage you to find a good financial planner that works very well with an estate planner. And we actually have our 4th webinar that's going to be all on estate planning with an attorney here that's part of PAC that specializes in that. So she'll be able to give you all the specifics. So if we ask ourselves, what does asset protection include? My answer would be everything. Even though we really don't think of it as that, you may have met in the past with a life insurance agent or something along those lines, and they may just think that asset protection is clearly just simplistically life insurance, but in reality, it is a lot more than that. So if we look at retirement assets, there are federal laws that protect most retirement plans and your retirement assets. If we look at, Social Security, our house, these are all types of things that we need to protect. So I would consider looking at our house, that is going to be a part of insurance, but I see like life insurance, disability insurance, kind of a different area than homeowners insurance or auto insurance, so the property and casualty piece of the puzzle. And then we can also look at protecting our cash. That may be in the form of an FDIC insured bank account that will insure $250,000 for each account per person. So when you look at it that way as a whole, it's a lot more than just insurance. So I definitely wanted to point that out because sometimes that's a misconception. So specifics to plan for. I really wanted to make this relatable when it comes to asset protection. So these are 4 things that we plan for. Income replacement, so that's going to be disability insurance. If we were to get hurt on the job, develop an illness, how would our family survive? What income would they have? And also risk of major medical bills. So this is going to be a big one. I've definitely seen this through my aunt and uncle, and we're going to discuss that a little bit. That will touch on Medicare and Medicaid, and then long-term care, which is going to be if you develop a long-term illness and need care, proper care. And then we'll also talk about life insurance in case of a premature death. So I always like to put this slide up that I created. Truly the number one asset is you. And I think I brought that up in the last webinar, the financial planning webinar, but truly the number one asset that you need to take care of is yourself. So that's going to come in the form of disability insurance, long-term care, and life insurance. So as you can see, we're starting with the insurance piece, and then we'll build our way up to protecting our actual physical assets. So disability insurance, the definition. So basically, disability insurance is a policy that will provide income if you cannot work anymore, or if you had an injury, an illness, a disability. So a lot of times these disability insurance policies, they're not going to replace your entire income, but it's going to be a portion of your income. So, instead of 100% of your salary, you can choose different levels, and you may choose 50%, 70%. So, we'll talk on the next slide. There's a lot of different factors that go into disability insurance. All right, so still talking about disability insurance, a few things to remember: that you have short-term and long-term disability coverage. So short-term disability is going to be a year or less typically. And then when you start looking at the long-term disability, that's going to be anywhere, basically your working years. So it could be up to 65. Some policies allow you to purchase a rider that takes it up to age 67. And then it's typically available through 3 avenues. The first avenue is going to be through employers. So through your job, sometimes employers will offer disability within your benefit package. And next, and also moving back one step, they will offer it, and typically they will offer you an option to increase that coverage if you want on, at your own expense. The next would be the Social Security Administration. So the best way to think about this is compensation, or if you are permanently disabled. And then lastly, we have our private insurance companies. So this is going to be if, it's not offered through your work or in it from, the Social Security Administration, but you want to go out and buy your own private policy, say you're self-employed, then that's another option you have. And that's what the pictures on the left side of the screen are based upon. So it's just stating that with disability insurance premiums, not everybody's is the same. And the main factors that go into determining your premium it's definitely first your line of work. So if you have a very risky job, and you're more likely, or you're more prone to get hurt, then they are going to increase your premium. That goes hand in hand with your occupation. And then the amount of income you make. So if you make a higher income versus, a lower income, your premium is going to be higher. And then of course your age. So if you're ever thinking about purchasing a disability policy through a private insurance company, then this is the type of things they're going to look at. And most of the time, policies pay monthly benefits, and there's a waiting period. So with the short-term disability, the waiting period, obviously is a lot shorter. When you start getting into long-term disability, you can actually tailor it to whether you want it to be 30 days, 60 days, 90 days. And that just means that the benefits won't start until that many days have passed. So here's where we're going to talk about Medicare. I brought this up because it kind of speaks to me in a sense of what if you develop major medical bills. So to be quite honest, I did not realize how much Medicare can cover when it pertains to Parkinson's disease. And so I've been, again, talking to my aunt, uncle. They're a great resource for me to learn through. And my uncle's actually in the process of getting a motorized wheelchair, and Medicare is going to cover it, but it is a process. And so I didn't realize how long of a process it was, but he's going through that now. That would probably fall under Part B, but in general, Medicare covers medications for Parkinson's disease, different therapies. So it could be physical therapy, occupational therapy, speech therapy. And, this all sounds great, but at the other end of the spectrum, the reality is that Medicare is not going to pay for all of our costs, especially when you have an illness. So you all already know this, but expect to pay out of pocket cost as well, even when you have Medicare coverage. I'll briefly go through the different parts. So Part A is going to be more inpatient hospital type coverage. Part B is going to be your outpatient medical coverage, and it could also include equipment. And then Part D is your prescription, or prescription coverage. Look at Part C. This is a supplemental policy that you can buy, and it's through a private insurance company. But you can purchase that. It's not, you're not obligated to purchase it, but you can at an additional cost. And it would include within itself, A, B, and D. Medicaid, I did want to bring this up briefly as well. So Medicaid is different in that, with Medicare, you're going to apply for it at 65 and, get on Medicare at age 65. But with Medicaid, you have to qualify for it. So usually it's for low income adults, children, pregnant women, elderly adults, and people with disabilities. And it is administered by the states, and it's funded by the states and the federal government. So I wanted to bring up one thing that at Fulcrum we don't agree with, but a lot of you might have heard of this, so I wanted to throw it in there, and that is Medicaid spend down. I don't know if any of you have heard of this, but it is a process of basically spending down your assets so that you qualify for Medicaid as low income. And so, like I said, there's a lot of maybe agents that specialize just in that. We do not do that, nor do we encourage that for numerous reasons. All right, so Kiana, do you want to do the first Q&A before we get into long-term care?
Yeah, sure. Do you want to start out with the poll question?
Yeah, that'd be great.
Okay, so we have a quick poll. It's going to pop up on your screens here. Let me just launch it. Okay, it should have just popped up. And so the question is, what is the first thing that comes to mind when you hear the word risk? And if you'd like to explain why.
I should have put of all of the above.
Yeah, well, yes, that could be an option as well.
But I think everybody would have chosen that.
Okay. Looks like the answers are rolling in.
Perfect.
Okay, we've got about 50%. All right, well, so far, investment risk happens to be the highest one, but we have about 3 more people, and the results will be in. Okay. I think maybe 2 more now. All right. Well, while we're waiting, so far, Melissa, it is investment risk is coming in at the top answer selected. It's about 57%. And then we have health risk as the very next at 29%. And then we have income risk being 14%. If anyone would like to share why they chose their answer, feel free. You can raise your hand, or you can put it in the chat box. Okay. I'm not seeing any hands raised, but we'll go ahead and end the poll here. And if anyone has any questions about just, whatever else Melissa has covered so far, sorry, we can go ahead and discuss that as well.
And I do just want to add, based upon the poll, In a way, that's surprising to me, because I mean, I understand market risk, investment risk, and then that potentially leads to what assets you have to help you, if you experience any of these things. But I really thought we'd see more so of an income risk, which uh, only because, when I think of income risk, I feel like it kind of goes hand in hand with the health risk. But if anything serious were to happen, um, would you have enough income to support that and to support your family still? So I'm glad we did that poll, because it was eye-opening for me that a lot of people are concerned about investment risk most of all.
And Melissa, we actually have a comment here. So I guess there might be an issue with the chat box being disabled. So I'll check into that on the back end.
Okay.
But Scott said that all the risk items are concerning. Market risk could be a current concern due to the market conditions.
Scott, you are absolutely correct. So all four of these choices go hand in hand. They play off of each other. So, in our current economy and market, you do have a right to be not scared, but worried about market risk and everything. But that would be a whole nother topic offline. So, happy to chat later though. Any other questions?
Another comment in the chat box we have here, Dora said, investments are a main part of our income when retired.
You're very correct, Doris. Along with Social Security, which Social Security is not supposed to be viewed as your only source of income during retirement. So I definitely see that your investments are a huge risk, because they are a huge source of your income. So thank you so much for pointing that out. I agree 100%.
Does anyone have any other questions before we move on? And I do want to let everyone know you should be able to use the chat box now. There was just a setting kind of clicked off there, so I fixed it for you guys. Okay, well, I'm not seeing any raised hands, nothing coming through the chat box. So we will have another Q&A at the end of the presentation. So if you want to just kind of park your questions in the chat box, we'll address those at the end.
All righty. Thanks, Kiana.
Thank you.
So we will continue with long-term care insurance. This is a topic that I feel like is talked a lot about more recently. So, for example, I took a lot of insurance classes in college because I was a finance major, but we did not really talk about long-term care. I really only learned about long-term care in depth when I was, a planner on the job and working with other advisors. And I truly understand the importance of it now. So especially as I'm getting older, I'm seeing my family members struggle and need care. So the question we should ask ourselves when it comes to long-term care is, who will care for you when you can't care for yourself? And a lot of us don't like to think about that. But this is a couple of statistics below. Don't worry, they're not supposed to equal 100%. I was already adding them up and I was like, it's just meant to be different statistics. So 65% say that most people need long-term care insurance. And that's quite a bit of people that think that, it's necessary. But there's a big disconnect in that only 57% say they personally need it. So looking at themselves, and then only 15% actually own it. And I can see why this percentage is so low. A lot of times it's perceived as being very expensive, but let's continue and learn a little bit more about it. So we'll start with a few tips that I've learned throughout the years. And the first one is going to be buy young, if possible, before you are diagnosed. So this is a very hard one and difficult one to navigate because, quite frankly, we don't know what our future holds. So it's hard to, invest our money in a long-term care policy when we're not even thinking that, we may be diagnosed with Parkinson's disease or anything like that. But the fact of the matter is, once you have that diagnosis, it is nearly impossible to qualify for a long-term care policy. So just keep that in mind. I don't agree with it, but that's how it is in our industry. Also, think about coverage for the caregiver, typically the spouse. So this is extremely important because caregivers, like I said, most likely sometimes it's the spouse. We have to worry about them a lot as well, their mental state. When they start to get older as well, develop illnesses. I mean, maybe they won't, and I surely hope not, but we have to think about who's going to take care of them. And so that's extremely important to look at long-term care from that aspect. Also, I would encourage you to compare traditional policies versus hybrid policies. So long-term care has really transformed throughout the years. What I mean by that is in the marketplace, it used to be just standalone traditional policies that only covered long-term care. You would get to customize it a little bit more. So you would choose what type of benefit you would want as far as a dollar amount monthly. And then you could choose the years. So maybe I've seen commonly like 4 to 6 years of coverage. And then you could choose to include an inflation rider on that. So if costs go up, then your amount that you receive would go up. So things like that. And when you're talking about a traditional policy, you probably have heard the words reimbursement and indemnity. And the difference between those is reimbursement is really just going to be where the insurance company would pay the benefits to, the caretaker, whatever expenses there are, medical, caretaker, anything like that. So it's a lot more seamless. It's definitely more popular versus indemnity, which is where they're going to give you a set amount each month and you may not spend that much, but you're going to still get that much. And a lot of people think that, oh, well, that's a great thing. And for some people it is, but for others it's not, because it does expose you to possible risks such as people around you. And you hope this never happens, but people around you using that money for not in your best interest. Let's just put it that way. So definitely compare the two. I will say in today's marketplace, there's only about 3 to 4 traditional carriers. So most of them are hybrid policies now, which a hybrid policy can be in the form of life insurance or an annuity. And I just threw in this example just to help you understand it a little more. So we've got Molly, who's 55 years old. She has 2 sons who are in college. And she's married, but she doesn't want the burden of anybody taking care of her and her family if that were to happen, if she was to become ill. So she has $75,000 in discretionary assets. So keep in mind, this is money set aside. It's not an emergency fund. It's not money that she's going to need to touch anytime soon. So she decides to purchase a life insurance policy with a long-term rider included. So she'll invest the $75,000. And then if she were not to use it and she wanted to get her money back, then, and this definitely was not a thing of the past, but you do have some flexibility depending on what your policy is set up like, but you can get your return of premium back, or if you never touch those benefits and you pass away, your beneficiaries will get an enhanced death benefit. And then a step further is if you do need to use this policy for specifically long-term care benefits, they are going to give you a large bucket, much larger than what you put in for those long-term care benefits. And it seems, you know, you may be thinking, well, how is that even possible? But it's all in the setup of the policy. And I will say that these policies can be complicated. So I would really encourage you to, you know, look into them by yourself, but also work closely with somebody that has the knowledge and education regarding these policies, because they can be a very, very good thing for the right situation and the right person, but they do tend to be complicated. So now we get to life insurance. A lot of times life insurance is considered an obligation. And whenever we think of obligations, I don't know about you, but I want to put it off. Like, you know, you just don't think you need it. We can do it at a later time. But we really need to think of life insurance as more so an opportunity. So if your loved one was to pass away, that could be a source to replace your income that you were dependent on. Pay estate taxes. Different scenarios may include that you want your beneficiaries to be able to pay off the mortgage, debt, things like that. So this is where life insurance can really be put to work. And I will say there's smaller policies, burial policies, which are going to cover a funeral cost, all the way up to, you know, $1 million policies and more. So coverage depends on your situation. Different types of life insurance. We've got term, permanent, and group. So term is going to be the simplest form of life insurance. Simplest to understand. Basically, you're going to say you want a coverage amount of, let's just say, $250,000, and you're going to choose a term, whether it be 20 years, 30 years, and after that term, you're going to pay that premium for that amount of time, and then after that time expires, you're no longer covered. It's good for a lot of different situations. Like I said, I don't want to give, and I can't give any recommendations of where you should use that. But, you know, I will say it's a good fit for a lot of people. So is permanent insurance. So permanent life insurance, just like it sounds, it's going to remain in place as long as your premiums are paid. It's going to remain in place your whole life. So there's a few different types of permanent insurance. There's whole life, which is you know, going to stay in place your whole life. You can do up to 100. Some allow you to do up to 105. And it's also going to allow you to build some sort of cash value. And the thing is with that, though, you will not be able to choose any investments or anything. So it's going to be a consistent rate of return with cash value. The next one is going to be universal life. So with universal life, this is going to be where we get into flexibility. So because we all experience different stages, incomes in our lives, universal life is going to allow us to change our premiums if we want, which in turn is going to change our death benefit. But you have the ability to do things like that. And of course, it is also going to build cash value. The other one, variable life insurance. This is going to be the most risky type, but a lot of people use it because they want to maybe look at it as an investment as well. So with this, you can actually choose how you want your cash value to be invested, as aggressive as you want or least aggressive. But the fact of the matter is it's risky because you can lose money and, you know, affect your death benefit essentially. So that's permanent. Some people like to do permanent because they want to borrow against it, which you would be borrowing against your cash value, which keep in mind, it takes a while for that cash value to build. So it's not like you're just going to take out a permanent insurance policy and then immediately be able to take out a loan against it. Anyways, group life insurance, that is typically offered by employers. So it's usually part of the benefit package. So they usually will do, I mean, just this is an example, 1 times your salary. And then if you want to add additional coverage, you can purchase that on your own through their carrier. And then the biggest difference is the premiums are not based upon you individually, but they're based upon the whole group. How much coverage do I need? So this is a question that I get a lot, and I'm going to give a blanket answer that you probably don't want to hear, but the answer is it depends. I truly do believe that everybody's situation is different. So, somebody may need $1 million life insurance, or excuse me, life insurance policy. Someone else might need 100,000. So these are just two calculations that are examples of how it can be calculated. So the first one is multiply your gross income by 10 to 15. And if you have children that are going to be going to college, add an extra $100,000 of coverage for each child. So that's a very quick, basic calculation. Not really looking into too much of your situation particularly. The next one is going to be where you add up all of your expenses. So it's going to be your expenses now, all your ongoing expenses, and then all your future expenses. And with this, it's kind of hard to project future expenses because you honestly don't know what you're going to be spending in the future, but we can use it and predict it as a percentage of our current expenses and our ongoing expenses. Again, it would be an estimate. So from there, you're going to add your current financial resources. So all your investment accounts, anything like that, that could offset those expenses and pay. And then whatever you're left with, well, whatever bucket of expenses remain, that's the amount of coverage you would get. Again, I am not saying that I'm a proponent of either of these. I just wanted to give some examples. I'm not sure I understand. Sorry about that. That was my Apple Watch talking. Anyway, now we're going to move along more so to protecting our assets from creditors, predators, in-laws, and outlaws.
Melissa, if you don't mind, we actually have a couple things in the chat box before you move on.
Yeah, definitely.
So we have a question from George here,
Okay.
and he asks, are long-term care benefits capped? For example, Molly's is capped at approximately 400,000, and so regardless of longevity, so he wants to know if it was capped regardless of the longevity. Yeah.
Some policies can be, yes, especially so if you're talking about a traditional policy, then like the standalone policy, then yes, those are going to be capped because you're going to choose the term. So say 4 to 6 years, it's going to cover you for that amount of time and that alone. Now, if you're looking at more so of an annuity setup, it will be capped based upon eventually, I mean, I showed you that chart where there was like $400,000 of benefits, but if you actually do exhaust those, then yes, it would start affecting how your annuity is working, and you would not, it's not an unlimited type of thing. So George, it is capped in most cases.
And wait, I think I saw it. Okay. You're welcome. He says thank you.
Oh, awesome. Welcome.
I'm sorry. Yeah, I'm saying you're welcome. Like I answered. Huh? Okay, so, and we have a comment here in the chat box as well. So Scott said, another plus of group insurance is that typically you don't need to qualify individually. The risk is spread across the entire group that is covered.
You are absolutely correct, Scott. That is a good thing. If your company offers you benefits like that, take advantage of it. On the downside, the only bad thing about that would be if you left your job, then of course you're not going to have those benefits anymore. But yes, I agree completely. It's a lot easier to qualify. You don't have to go through personal underwriting or anything. It's instant.
Right. And that was all. I'll turn it back over to you.
Okay, thank you.
Mhm.
So back into the final topic that we're going to discuss tonight. That's going to be, how do we protect our assets? So these are a couple strategies that I've used and I'm familiar with, so I wanted to bring them up to you. Again, you're going to hear me say this a lot during this presentation, but these will not apply to everybody because everybody's different. So the first one would be to have an estate plan. This is especially important. And I mean, a lot of us have wills and things like that, but you truly want to have a whole estate plan, especially if you're wanting to leave a legacy to your family, your loved ones, and also if you have assets to protect. As always, be tax smart. I think that's an obvious one. The next one, it's not going to apply to everybody, but form an LLC. So I've seen in a lot of cases where, people may own real estate property and they rent it out. So the thing is, if you don't put that real estate in an LLC, and this is strictly just a viewpoint of protecting the asset. So, say they sued you, the renter sued you for some reason, then if it's not an LLC, then they can come after your own personal assets. However, if you do put your real estate in an LLC, they would no longer be suing you guys individually, but suing the entity. So there's a lot more discussion to be said on that, but I just wanted to briefly bring it up. And then of course, insurance coverage, life, property and casualty, everything like that. And the last one, I think that's pretty obvious as well. Work with an estate planning attorney, and they can help you get everything drafted and put into place. So if you've watched my webinars before, you know I always like to show a video. So this is going to be a video from the movie Up. And I think it's a really good scene. It's lighthearted, it's kind of funny, even though none of these topics aren't funny, but just wanted to show it to you because I thought it was very fitting for our topic. So I will go ahead and play that, and then we can talk a little bit about it if we want to.
Quite a sight, huh, Ellie? Mail's here. Shady Oaks retirement. Oh, brother.
Hey, morning, Mr. Fredrickson. Need any help there?
No. Yes. Tell your boss over there that you boys are ruining our house.
Well, just to let you know, my boss will be happy to take this whole place off your hands and for double his last offer. What do you say to that? Take that as a no, then.
I believe I made my position to your boss quite clear.
You poured prune juice in his gas tank.
Yeah, that was good. Here, let me talk to him.
You in the suit. Yes, you. Take a bath, hippie. I am not with him.
This is serious. He's out to get your house.
Tell your boss he can have our house.
Really?
When I'm dead.
I'll take that as a maybe.
So again, I just thought that was a very good clip to demonstrate the risk of predators, in-laws, and outlaws taking your assets. In this case, it was Carl, and they're trying to take his house away from him and put him in a retirement community. So lastly, I want to end with a couple key takeaways, and we're going to talk about starting with the basics and making it a part of your plan. That is asset protection. Start with the basics. It's really important to determine, and I know I sound like a broken record, but you really have to determine which risks pertain to your scenario. And that's when you would want to sit down with somebody, look at your whole financial plan. Again, you know, I'm a huge proponent of developing an entire plan and then looking at what you need to do to prevent those risks, what kind of coverage you could do. Education is key. I think it's very important. I like to educate my clients on anything that I'm talking about with them or suggesting to them. Point being, because, you know, going back to number one, sometimes we don't need as much coverage as somebody wants to sell us, and that's big. So always keep that in mind. Number three, your journey is specific to you. So, for example, if your buddy was like, oh yeah, I just, you know, purchased $1 million term life insurance policy, and then you think to yourself, well, maybe I need to go do that. Absolutely not, unless it pertains to your picture. Make it a part of your plan. This is so important. A lot of times we like to put this area off, but we really shouldn't. Have a financial plan that covers all areas of asset protection. And hopefully through this webinar, you've learned that there's many layers to asset protection, not just insurance. And I will encourage you, no matter if you have a small amount of assets or a large amount, just always go through the process of protecting yourself and working with an estate planner, which is the last one. Make sure your financial advisor and your estate planner work with each other. This is extremely, extremely important. You want to make sure they have a really good relationship with each other. The financial advisor is the person that's really going to help you come up with these ideas, and the estate planner is going to be able to put it in written form for you and documentation. So they go hand in hand. And that concludes the webinar. Again, I always just want to say thank you for having me. And if you think of any, I know we're going to do another Q&A, but if you happen to think of any questions or thoughts or comments, please do reach out to me. I know Kiana has my information that she can give to you. And then my last slide is just lovely disclosures for compliance reasons. So Kiana, if we want to see if there's any other questions, that'd be great.
Absolutely. Thank you, Melissa.
Thank you.
So yes, if you all have any questions, feel free to raise your hand if you'd like to ask a question live, or if you'd like to utilize the Q&A or the chat box, feel free to do that as well. But we will go ahead and take your questions. Scott says thank you.
You're welcome, Scott. You made a lot of good comments. I appreciate it.
Any other questions or comments? Not seeing anything. Okay. Well, I guess we can go ahead and wrap up. Thank you so much, everyone, for joining us tonight. Hopefully there were some key takeaways that you'll have with you after today's presentation. You might have already seen it earlier, but we are recording today's session and it will be available on our YouTube page as early as next week. So if you missed anything or just want to check back to hear something again, feel free to look at our YouTube page and it'll be there. In the meantime, if you have any questions for Melissa and you didn't quite catch her contact information, feel free to reach out to me and I can connect the two of you. But again, thank you all for joining us this evening. Thank you, Melissa, for the amazing presentation with all the good tips and tricks of asset protection. So thank you so much, everyone, and we hope to see you at the next webinar.
Yes, thank you, everybody, and thank you, Kiana.